How will changing refund policies impact consumers and retailers? And should 3M be sold after its most recent run?
This is InvestTalk. Independent thinking, shared success.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our May 15th, 2024 edition of InvestTalk. I'm Justin Klein, and I'm here to answer your finance and investment questions, give you perspective, develop with over 20 plus years of investment experience, and usher you through these interesting times, an era that is ushering in a multipolar world, and that creates a different dynamic between asset classes and the types of companies that you want to own. It creates an inflationary environment that should color the asset classes that you should be overweight and underweight. And that's what I'm here to help you navigate. This is new. I know we've been dealing it really since the pandemic's, 4 years since the pandemic? But you can clearly see the economy is different. The markets are different. And so, in many ways, investors are trying to figure out what this new world brings. This isn't your post-GFC market or economy. When interest rates were at rock bottoms, when the inflation picture was meager, the nominal growth in the economy was very low. Currently, the nominal growth is pretty high. Now, is that healthy growth? That's another topic of discussion, but it's growth nonetheless. And earnings are growing. And so this is an environment that takes a new, fresh perspective, and that's what we're here to bring. Now, we're going to look at the market performance for today, as well as run down some show topics. But as usual, we're going to hit our first caller question now.
Hello, my name's David, calling from San Jose. Calling regarding a natural gas company, OKE. Wanted to get your thoughts and a good entry point on the stock. Thank you.
All right. Looking at ONEOK, and this is a name that we've owned for clients for a long period of time. And you said it's a natural gas company, and I need to correct you there. It is not a natural gas company. It is a natural gas transportation company, as well as natural gas liquids. So it's a very different type of business. Think of it like collecting a toll. The more natural gas it moves, the more money it makes. Okay? And because natural gas prices are low, there's a lot of drilling throughout the country. We've talked yesterday, I think it was, about how we're producing a record amount of oil and gas in this country. The most that any country has ever produced. And so, OKE here is benefiting from that. Just higher volumes. And it's at a fresh 52-week high. It didn't close at a 52-week high, down 7 cents today, but right near there. So, it's a bit overbought near term, but the whole market is in many ways. So, is this the perfect time to buy it? Probably not, but, we love the name. We think it's great assets, and we'll continue to kind of print cash going forward. Current dividend yield, 4.8%, and that likely to go higher over time. So we like ONEOK. OKE is the symbol. Now, we have a lot of ground to cover in the next 45 minutes, and our main focus point is in regards to retailers cracking down on returns. A lot of people don't know this, and how will this impact you, the consumer, as well as these retailers? In addition, we have other topics on the docket. One is opportunity zones. Opportunity zones. This was post the Trump era tax cuts. There was a rush towards the tax incentives built into that that brought a lot of literally billions of dollars, billions and billions of dollars flooding in to try to avoid taxes. And in many ways, that program is struggling. And part of it, the structure of it, part of it is the economic environment that we're in that is very different. So we're going to look at that and what lessons can be taken from that story. Also, the meme stock craze is back, but all you have to do is look at trading from the big brokers and the small brokers, Robinhood to Schwab to E-Trade, etc., as to how fleeting that trend can be. So we'll look at those numbers and where we are at compared to the first meme stock craze. And then lastly, if we have time, we're going to look at what investors are thinking about when it comes to the overall economy. Are they overweight equities? Are they underweight? Are they more bullish? Or are they more bearish compared to the last few years? So we're going to look at all of that. But that's on the docket for me, as well as your voice bank questions. One is in regards to 3M, and the other is a mutual fund, American Funds Mutual Fund, that we'll take a look at. And of course, we will answer some comments, some questions from the comment section over on our YouTube channel. But of course, your finance and investment questions come first. You can give me a call now at 888-99-CHART. Now we're going into a short break, and on the other side, we will take a look at today's market activity, closing at a new all-time high, as well as take questions from the InvestTalk listener line at 888-99-CHART.
You are invited to be a part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
Enjoyed our insights on InvestTalk? Great news. Our podcast is available on all major platforms. Make sure to subscribe wherever you listen to your podcasts. Get the latest in investment advice across Spotify, Apple Podcasts, and more. Subscribe now and join our community of informed investors. Now let's take a look at the market today. It was a decidedly positive day overall, and mainly because the CPI number came in a bit lighter than expected. And we know that the shift in market expectations for Fed policy can move markets up or down. And in this case, it moved markets up and the dollar down, most importantly. And we talk all the time about how a higher dollar tightens financial conditions and a looser dollar helps them. And the dollar hit its lowest level since early April, and that is positive for risk assets. And that's why you had the S&P close at an all-time high at 5,308 today. Also, the Dow closed at an all-time high, as well as the NASDAQ. So the NASDAQ Composite Index hit 16,742, and that was an all-time high as well. Now, market's overbought. We're into some major resistance. So could this be, a near-term high? Sure, that's certainly possible. Definitely, probably not an area you want to load up the boat, shall we say. But it's a clear indicator. When you're making new highs, you can't argue anything but the technical setup is positive. And with inflation remaining somewhat tame, right? You had that resurgence in the first quarter. Oil prices have pulled back recently. There's been less pressure on wages. You've seen the jobs market weakening a bit. And most importantly in the CPI number is actually the shelter inflation continues to ebb. And there's a lot more room for that to go lower throughout the year as well, especially as in many markets, rent income or rental prices have fallen. And remember, the shelter part of CPI is the owner's equivalent rent. And so that is a very lagging indicator, and we'll kind of weigh on the CPI number over the short to medium term. Now you can counter that with, hey, is the Fed getting too dovish too quickly? Is that going to weaken the dollar? Is it going to bring the cost of energy back higher, oil prices, for example? You've already seen a breakout in other materials like copper, gold's breaking out. And then you also have the ag industry. The ag industry is getting some inflation there as well. So you're definitely seeing a picture where near term, you could see evidence for the Fed to be less hawkish. But in the back half of the year, that could change, right? As you get in closer to the election time and into year end, I think you're likely to see a resurgence in inflation. And there's definitely a battle here between the political aims of Washington as well as Fed and Treasury policy. Now, what I will say is the Treasury policy as of late has been a bit more hawkish, issuing more bills here going forward. Now, the Fed winding down QT or lowering QT certainly is helping the liquidity dynamics. But net, overall, liquidity remains relatively robust. And that's why when you see any little bit of good news, the market resurges because that's the release valve. And why you are likely to continue to see higher prices for equities in the medium term until the liquidity dynamics in the market change, which it does not look like it's going to change materially anytime soon, at least now until the election. Now let's keep things moving and pivot back to the InvestTalk voice bank. This one came in earlier at 888-99 chart.
Hey, Justin and Luke, this is Art from Tucson. Today I'm calling in about 3M company, MMM. I own it. Seems to be in some positive momentum territory after being down for a long time. It's still in a overall bearish trend, I suppose. But picking up momentum, I'm up about 14% on it. Wondering if I should trim or add or just hold on to it for now. Also wondering about its spinoff in the healthcare space, recent spinoff, Solventum Corp, SOLV. And what do you think of that company? I acquired a few shares of it during the spinoff and wondering what to do with that. Thanks again for all you do for us.
All right, looking at 3M and Solventum, the technicals in 3M have certainly turned. And that's something a lot of investors have been waiting for, and frankly, I've been waiting for. Now, does that mean you jump on? Not necessarily. You know, it's a company that still is struggling in some ways. They have the issues with the that lawsuit that they're dealing with. I think it was in regards to the earplugs, if I'm remembering correctly. But, you know, still their revenues last quarter were flat year over year, and earnings this year are supposed to be down 20%. So, you know, how much are you really going to pay for something that's supposed to earn $750 this year, roughly $730 on a $101 stock? They're talking about, you know, 14 multiple for low growth. That's probably fairly valued to maybe slightly undervalued. So I wouldn't be quick to sell it though, because 14%, that's nothing. And, you know, the technicals are positive near term. So if you want to sell it, you'd want to have an out. You want to see the technicals weaken to indicate that, yeah, this momentum has certainly waned. But right now, the momentum is certainly fine. Now, there is resistance, overhead resistance right around 107, 110, but it certainly could get through there with time. Now, Solventum, the spinoff, I don't know much about it, frankly. It's I haven't looked at it. I'd have to get a little more details on it. But typically what happens with these spinoffs is they underperform in the first 6 to 12 months, mainly because of what you're saying. I'll get the spinoff. I don't know much about it. And they just get rid of it and they don't understand the business. And there's typically some opportunity there over the longer term. So it's already down pretty significantly from its spinoff price. So I probably wouldn't sell it now, but I would take a deeper look at it. And I think there's probably opportunity longer term. Thanks for the call. Now we're moving into a short break. Still to come, I'll tackle our YouTube comment questions. But give me a call now at 888-99-CHART. Hey InvestTalk community, Justin and Luke here. We are so thankful you've been with us through this investing journey, but we are just getting started.
That's right, Justin. We're excited to bring you more exclusive content. Think more of the critical analysis and expert advice that you love.
You'll get insights into smart investing strategies to help you navigate these turbulent times.
Don't miss our live Q&A sessions every weekday at 4 p.m. Pacific, where we answer your burning investment questions.
Just call our InvestTalk listener line at 888-99-CHART, leave your question, and we'll tackle them on the next show. Who knows? Your question could be the next big topic we explore together.
So stay tuned and call 888-99-CHART to leave your comments. We're here to make investing accessible, understandable, and hopefully even a little more fun.
Chart your path to financial freedom here with the InvestTalk podcast. Now let's take a look at our main focus point today, and that is regards to retailers. And in 2023, 81% of US retailers implemented pay to return policies in some capacity. And I think this is a very interesting trend that was naturally going to happen. There's naturally a reaction to a reaction. And, I think of this as the Costco effect. Costco has always had a very liberal return policy. And then people started to realize it was too liberal, and returning TVs that were a decade old, couches that were a decade old, things that obviously were used their entire full life of the product, and then they still sent them back. And Costco changed their policies. I think you can only return electronic products that are within the last 3 years or something like that. So they were the first to kind of close some loopholes within the system. But a lot of other retailers have pretty liberal policies as well. Companies like Amazon, Macy's, Walmart, Staples, TJ Maxx, etc. And they're rolling out things like shrinking return windows. So it's no longer unlimited amount of time, or within the next year, it might be only 2 weeks or 1 month. They're also charging for some returns, saying, there's restocking fees, for example. And in some cases, they're just telling shoppers to keep it. So not even dealing with the costs to restock. And the costs to restock most goods, on average, are about 40% of the original retail price. So if you understand how retailers work, if they're buying something, if you're buying something for $20, it typically is costing them around $10 to buy that in wholesale. But if 40% of the retail price it costs to put back on, it means that their cost now is $18, and they may not even be able to sell it for $20 once it is back in stock, because it might be used or open box. And so they're losing money on both ends. And according to the National Retail Federation, 14.5% of all retail sales, there's $5 trillion of retail sales last year, 14.5% were returned. That's $743 billion in 2023 alone of returned goods. That's an enormous amount, especially for these large retailers. And if you understand the retail business, it is a small margin business. That's why you typically get the big box retailers as the ones that win out, because they can get scale and they can earn a small percentage on a lot of sales. Now, what you don't know is that most retailers are implementing practices to track and target return behavior. And there's software to do this. So they use third-party loss prevention services to track risky return behavior. And basically what the software does is it flags returns that are abnormal. If the shopper is consistently returning goods, or maybe it is a fraud, meaning the product was stolen from the store. This happens a lot. They steal from the store and they go back to the same store and return it without a receipt. And so these are things that they're starting to crack down on. And in some cases, they're saying they're reversing the reversal of the charge, saying, okay, we're giving you the return now, the system flags it, and then it reverses that refund. And it can even ban you from practicing the practice of returning products to that store altogether in the future. So if you are a serial returner, don't be shocked if you get blocked at some point by abusing these return policies. Now, the upside for retailers is if everyone's doing it, if everyone is tightening their return policies, that's going to help margins overall. So I think it's important to understand these dynamics both as an investor as well as a consumer. Now we're going to head into a break. On the next Invest Talk, we'll look into this topic. Beyond efficiency, are the markets sensible? Sometimes the financial markets do cross the sensibility line, but it's difficult to profit from that knowledge. We'll dig into that story a little bit deeper tomorrow, but for now, I'm Justin Klein and ready to take your calls at 888-99-CHART.
Did you love today's Invest Talk episode? Well, we want to hear from you. So drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by us. Dive into the comments now and become a part of our next conversation. Do you want to take your investment strategy to the next level?
We invite you to visit InvestTalk.com and submit your portfolio for a free review from us.
This is a fantastic opportunity to receive personalized advice and insights to enhance your results.
Don't let this chance slip by. Go to InvestTalk.com, submit your portfolio, and let us help you on your journey towards greater investment success. Thank you for watching. Make sure you like, subscribe, and hit the notification bell so you never miss an episode of the Invest Talk podcast.
This is Greg from Baton Rouge, Louisiana. I'm calling about two mutual funds, Alpha Whiskey Sierra Hotel X-Ray and IGR India Golf Romeo. I inherited both of these two. One is definitely a low fund, but the low has always been paid. I'm wondering what you think of these two funds. Thank you for your advice.
All right. This is a very interesting call because there's a lot of lessons to be taken from both of these positions. So you inherited them, not anything of you're doing, but now you have to figure out what you should do with them. And now the first is simple as I would sell both, but I'll tell you why. Now the first is the American Funds Washington Mutual A shares, AWSH. And this is a large cap equity mutual fund. And he talked about the load. Load is already paid. It has a front end load of 5.75%. Nobody should ever pay that. So lesson for everyone else out there, do not pay loads on your mutual funds. This is probably bought through a bank. American funds are and there's some fine American funds out there. I don't have any issues with the American funds in general, but the fund families that are sold are typically these that sold through a bank or an Edward Jones or an Ameriprise or no places that you really want to be running your investments through. Typically poor options and high fees and not fiduciaries that are acting in the best interest of the client. So wherever this is held, probably needs to be transferred to a bigger broker and you have more investment options, et cetera. But whoever bought it paid that 5.75% load. And in addition, there's what is called a 12B1 fee. And this is something that a lot of people do not understand is that not only do these brokers that are not fiduciaries, that they sell these A-share funds, they get that front end load of 5 3/4, but they also get the 12B1 fees each and every year. And for this one, it's 24 basis points. So they get a kickback every single year that you hold this. And it has an expense ratio of about 57 basis points, 0.57, which isn't egregious, but it's much higher than you probably should pay for just a large cap mutual fund that has a little bit different allocation than the S&P, but not far off. Not enough to make you say, oh, I'm going to pay that extra fee, continue to pay the 12B1 fee, etc. So I would definitely sell it, and what you should put it into, well, it depends on your goals and your risk tolerance level. Now, the other one, IGR, which is the CBRE Global Real Estate Income Fund, and whoever bought it was probably chasing after the 13.8% yield. The problem is this is I don't say a company, it is a fund that has continued to go down from its high in early 2022, nearly $10 per share. Now it's at $5.20. So great, you've earned some nice income since then, but you're still down net significantly from those highs. And what it is a closed-end fund with a very high expense ratio. The expense ratio is 3.86%. That's the total expense ratio. Okay, so that includes the advisor fee of 1.21, and then you have interest expense of 2.47, and then you have other administration fees, shareholder fees, etc. So very high overall cost to hold this particular fund. And from the looks of it, it's just a leveraged basket of REITs. And so it's going to move a lot with the REIT index. You're going to pay, so it's going to have a high beta to the REIT index, shall we say. But you're going to pay high fees, high interest, and not anything that you want to hold. A lot of people are going to chase after that yield, but they're just paying a lot of that back to themselves. Some of that is yield that just comes back to themselves as return of capital, as well as the dividend. So both of these I would sell, but for very different reasons. Thanks for the call. Now, you probably noticed that we are answering questions submitted via our YouTube channel. And Jim Lay says, do you think CEIX is a good stock to buy or hold? So this is CONSOL Energy, and this is an interesting one because it is a coal name. And coal is interesting because obviously governments want to wean us off coal because it is dirty. It's not really a clean way to burn coal. And this is a U.S. company, but they export most of their coal because of limitations of how much coal that we can burn here. So the question is, how fast are we going to wean ourselves off of coal? Now, last quarter, earnings were down 48%, revenues were down 18%. And this year, in total, earnings are supposed to be down 45% to $10.90. And it's a $90 stock. So you're at about a 9 times forward-looking earnings. It's on the low side. But next year, it's supposed to earn $14.85. If it actually earns that amount, it's closer to 7 times earnings. 2.4% dividend yield. And it looks like a very clean balance sheet. Very little long-term debt. So I like that. It looks like the dividend might have been eliminated, though. So don't expect that dividend. But it is pretty cheap. Free cash flow yield is around 20%. It's pretty high. So it's just a question of how much of a melting ice cube is this? I'm a firm believer that while those in government want us to wean off of fossil fuels, it's far more difficult than they make it out to seem. Right? It's easier said than done, and that's been clear year after year. And especially when coal can move around the world and we don't have control over what happens in other countries. The technicals are improving on this. It's now above its 100-day moving average, which it hasn't been since late last year. So I don't mind this. I kind of like the value here, and I'm going to fade the death of coal. Because like it or not, whether you love coal or not, it's still in demand around the world. Let's touch on opportunity zones. And this was a pandemic, or not a pandemic, a Trump era invention that was one of the signature plans that Trump put in place. And it was along with the tax cuts of 2017. And it had bipartisan support. So everyone was kind of on board with this. Why? Because those in the business community saw it as an opportunity, thus opportunity zones, to defer taxes and potentially even eliminate taxes if certain requirements are made, capital gains tax. And those on the other side said, okay, we're going to limit that to certain areas, underserved areas where there hasn't been a lot of investment. Gentrification, shall we say. And in some ways, that has certainly happened. Opportunity zones received $229 million in equity inflows in the first quarter, but that's down 2/3 from the $682 million in the same quarter a year before. And in total, funds raised $3.5 billion in 2023, but that's down from $9.7 billion in 2022. So what's happening here is there's a lot of these projects that are now underwater. There are 1,400 opportunity funds in the country that have attracted at least $38 billion in equity investments in total. Investing in things like multifamily housing, shopping centers, hotels, even single-family homes since 2018. The problem is that now you have high inflation and high interest rates. And so those combined are causing construction costs to surge and then capital costs to skyrocket. So a lot of times what happens is you have your construction loan, and that's a short-term loan, higher risk, higher interest rate, but the expectation, at least at the time a few years ago when interest rates were zero, was that once they were stabilized, they would refinance those and you'd get a 4 or 5% rate. Now those rates are much higher, 7, 8, 9%. And the numbers just don't really pencil out. And once again, costs are going over budget. So in that environment, the numbers worked, but in this new environment, kind of what I talked about at the top of the show, it doesn't really work out. Now, that's not to say that every opportunity zone is a problem and everything in that space has gone to hell in a handbasket, but it's a lot more challenged than most people who went into it had imagined. Now, the lesson here is really one of the biggest mistakes that the average person makes is to go into an investment endeavor, to avoid taxes, and that is their number one thought process. And too often, because it's at the top of the checklist of does this check the box of avoiding taxes or deferring taxes, etc., they ignore all the other factors, the risks involved, the overall total return after taxes, the opportunity costs of that investment, meaning, can I take that money and invest it somewhere else better? And so this is a perfect example of that, is that, yes, it did things that helped defer taxes for a number of years and sometimes completely eliminated them if they held on to the investment long enough. But remember, this is money going into underserved areas, and sometimes, many times, those areas are underserved for good reason, because the economy doesn't support those particular types of businesses or pieces of real estate, for example. So, as usual, government-directed investment isn't really working out here. Now, 2024 is moving fast, and we are nearly halfway through the year. And the big question is, did you anticipate these new highs? Did you anticipate, despite an economy that in many ways dumbfounds people, in many ways isn't what you expected it to look like with interest rates this high? Well, if you're confused on whether you are positioned well for this new environment, an inflationary environment, a higher cost of capital environment, meaning higher interest rates. If you need help, I encourage you to reach out to myself at our company, KP Financial, where we practice independent thinking and shared success, both on and off air. And we practice parallel investing, which means we invest right alongside our clients. So I encourage you to take advantage of our free portfolio review assessment by heading over to our website at investtalk.com, clicking on the portfolio review button in the top right-hand part of the screen. Now let's go to Paul in the Palm Desert, looking at URI, which is United Rentals.
Hi, Justin. Thanks for taking my call. I have a balanced portfolio. I do not own the stock right now. I've been looking at it for a while. Just wanted to get your take on, is it something that you would suggest adding at the levels now, or would you wait for a pullback? And if you like the company at all?
Yeah, I do like the company. And for everyone else out there, this is United Rentals. It's the world's largest equipment rental company, primarily operating here in the United States and Canada, and has about a 17% market share of the whole industry. So not dominant, but the biggest player. And its return on equity is 32%, which is very high. Long-term average is right around 30%. So very, very good business. It does have some debt, but not extreme, especially when you think of a very capital-intensive business like the leasing business or the rental business. So, and their products are in high demand, right? They rent industrial equipment, commercial construction equipment, residential construction equipment, etc. The technicals are strong. Return or relative strength is 93. Now, revenue growth is slowing, 6% last quarter from 30% in the first quarter of 2023. But earnings are up, supposed to be up 50. We're at 15% last quarter. Supposed to be up 9% in total this year, 8% next year. Those estimates are going up, so I like the earnings revision trends. I wouldn't say it's cheap. I wouldn't say, you're getting a bargain basement price, but you're getting a good company at a fair price. So, yeah, I'm fine with United Rentals. Thanks for the call. And a lot of people are going to look at it. It's trading at $712 per share. Notice I didn't say anything about that. It doesn't make it expensive. Everyone look at it and say, that looks expensive. No, it does not look. It's not expensive. You have to look at it in comparison to its sales, its earnings, its cash flow. And there's no issue here. You have about $1 billion in free cash flow on a $47 billion market cap. It's not a high yield, but it's solid. And once again, its profitability is very high. So I like United Rentals. URI. Now, this is InvestTalk. I'm Justin Klein. We have one goal each and every day, and that's help you achieve your own version of financial freedom. And our work continues after this final break. So get your questions in now at 888-99-CHART. Enjoyed our insights on InvestTalk? Great news. Our podcast is available on all major platforms. Make sure to subscribe wherever you listen to your podcasts. Get the latest in investment advice across Spotify, Apple Podcasts, and more. Subscribe now and join our community of informed investors.
Is something on your mind? You can call us 24/7 at 888-99-CHART with all of your finance and investment questions.
Hey, Luke, how you doing? I am a cash flow investor, and listening to the show, you guys have talked about shorter duration bonds. they're paying around 5% or so right now. So my question is, why would I put the money in bonds as opposed to a money market, which is now paying over 5% as well? I know that the money market's variable, but, we do believe that it's going to be higher interest rates for longer. And if I'm doing shorter duration bonds anyway, isn't that a very similar thing, but my money is more liquid and less prone to, yes, I can cash out early and get the full principal back without having to wait to maturity to get the full principal back. Just wanted to get your thoughts on the differences and the advantages of both. Love the show. Thanks a lot.
Well, what you're talking about are very similar types of investments. Short-term fixed income, whether it's a money market or, say, a short-term government bond ETF, shall we say. Both are very liquid. Now, money market's a little bit more liquid, shall we say. But often you can get a little bit better yield with, say, a short-term money market, so short-term treasury bond ETF. For example, I'm looking at one, it's 5.25% right now in yield. Not sure if you can get that from a money market. Some pretty good ones, maybe get close. But, if you have an ETF, you do kind of have to wait for that settlement. Settlement is going T+1 at the end of this month. So that's a positive where you can sell it and basically get the cash the next day. Whereas money market, if you need it that day, that's a little more liquid. But they're very, very similar. Both are going to fluctuate with interest rates. But like you said, if interest rates are headed higher, then it's going to be good to have that short duration. And that's what I encourage most bond investors. And so that's why to do. So anyway, let me rephrase that. That's what I encourage most bond investors to do, is to keep duration limited. So once again, you're splitting hairs here. Both work. It's just a matter of whether you want to pick up a little more yield from the short-term government bonds. And remember, not all bonds are created equal. A short-term government is very different than a 30-year treasury bond ETF like a TLT. Okay. Now, lastly, let's talk about the meme stock craze. And a lot of those stocks are down big today, and it just really shines a light on how quickly the phenomenon can burn out. And Robinhood is a good example. Most of the people who are betting on the meme stock craze are investing through the Robinhood app because they make it this fun game when it really shouldn't be. But in the first quarter of 2021, Robinhood saw trading volume surge to 133 million from 80 million, which is the last quarter of 2020. But that quickly faded and back to levels well below pre-pandemic numbers. Option trades ebbed as well just a quarter later dramatically. Now, Morgan Stanley, they saw trades down more than 37% in the first quarter of 2022 from a year prior. So as soon as these things lose their steam and the momentum, people lose interest. And so what you're getting from the data from the brokers, right, because they're seeing all these trades come in, is that this is a very flash in the pan type of moment. Now, can you gamble and make the right trades and get in at the right time and hit that high? Sure. But you could also go to Vegas and put it all on black and hit big. So on top of that, you have to look at the environment that we're in. Interest rates aren't near zero anymore. And so it's a lot more enticing to pull that money out and put it into something that is actually yielding something nowadays. Back then it was, hey, I had no alternative, right? And people can take that money and dine out, right? If they hit it big, they're going to cash out quicker than they were before because they might want that money to travel, for example. So don't get caught up in the meme stock craze. It's interesting, but that's about the extent of it. All right, that about does it. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. And be sure to rate and review on iTunes as well. And check out InvestTalk in video form over on our YouTube channel. Just search InvestTalk with 2 T's. Independent thinking, shared success. This is InvestTalk. Good night. Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.